I think basically, when you look at how much gold and silver and indeed platinum group metals have soared in recent months, some sort of correction was definitely on the cards. But the interesting thing is that the whole thing has really been a short squeeze. If you look on COMEX in particular, the speculators are just not there. They haven't really bought into it. The way I would measure that interest is looking at open interest. An open interest in gold is less than half the long-term average. Open interest in silver is roughly at the long-term average. There are obviously a few speculators in there, hedge funds, whatever. Not all that many. So this shakeout, it looks sort of suspiciously coordinated. I don't mean that, over the weekend, various bullion banks got together and had a meeting and decided to bash the market. But you do get this feeling, when you're a jobber. I've known jobbers, which is really what they do. The market maker is a jobber, basically. I've known these guys. I've been on the other side of them since 1970, and they do have this sense, if you like, in the market when it's right to bash the price of something which they're short of. It's almost like a second sense, and if they haven't got it, they're not going to survive terribly long in whatever they're dealing in. So if one good dealer has got the feeling this is the moment when it's going to come off, the others also have the same feeling. So you get this sort of compounding effect. And of course, I think what the buyers are doing in this, and remember, we're not talking retail market here, we're talking about wholesale market, and we're talking about big derivatives. The buyers, I think, they would just sit on their hands and watch this play out a bit before they decide, shall we buy some? And if so, what's a level? And so on and so forth. So, this is why I think this shakeout has been so severe. I'm looking at what's happened in silver. Silver is down nearly 7%. Platinum's down 5.7%. Palladium down 5.3%. And gold, as you said earlier, is 5%. These, given the rise that we've seen, this isn't actually all that great. You would just say this is volatility. I've always told people, don't trade this market. You'd be nuts to trade it because the guys on the other end are so powerful. They'll take every cent you've got off you if you're going to trade it. And, the answer basically is that you've got to work out why you're interested in gold and silver. You've got to understand what gold and silver are, particularly gold in the current context, what it is. You've got to understand that it is legal money without counterparty risk. Forget what the US Treasury says about gold being a pet rock or whatever. The reality is that in our common law and in everyone's common law, gold is money, it's final settlement. There is no counterparty risk. And the volatility isn't so much in gold. Obviously there's been volatility in gold, but it's mainly in the currencies. So when you see, for example, the People's Bank of China buying gold, the way to look at it is actually they're selling dollars. And they have other use for those funds. But basically they don't want dollars. So that's, if you like, the sort of their gold purchases are almost the small change, which they haven't got any other use for because they've got quite enough gold. Not necessarily within their reserves, but the nation has lots of gold spread around various accounts, including the People's Liberation Army, the Communist Youth Wing, and so on and so on and so on. So that's the way to look at it. So you've got to think, okay, do I buy gold because I think that paper currencies are going to lose purchasing power? If you think that, then the answer is yes, and you hold it, you hoard it, you tuck it away. Otherwise, don't mess with it. Forget it. It's a waste. You'll just have sleepless nights if you try and trade it, because I can tell you, you try and trade this market, they will take you for every cent you've got. That's the reality of it. I think there's another point which is worth making. We've seen various large American banks turning bullish on gold. Jamie Dimon said he wouldn't be surprised if it went between 5,000 and 10,000. You had Morgan Stanley saying, you should put 20% of your portfolio into gold, which actually is an extraordinary statement from an establishment bank. like that. I could imagine that Scott Bessent would sort of phone him up and say, "Why are you messing up my world?" But so they've turned bullish, and from the point of view of market makers, the bullion banks who are trading, if you like, on the right side of the quote, this is not helpful to them at all to have this. So this is why, if someone told me that there was a coordinated move to basically bash gold and silver and also platinum group metals lower, I could believe it. I really could, because what they would want, it's not that they're anti-gold or silver, it's just they want to get their position square. And I think this is a desperate attempt to just do that. Let's try and, get our bears closed a bit, and then at least, we can trade it at a higher level. I think that's what's going on, if you like, in London and New York.
What we're really watching right now is the anatomy of a short squeeze disguised as volatility. Everyone's trying to call this a correction, as if that word somehow makes it sound orderly, rational, and predictable. But when you peel back the layers, what's actually happening in the gold and silver markets right now is nothing less than the system shaking from within. We've had an extraordinary run. Gold blasting through historical highs, silver screaming upward, platinum and palladium along for the ride. And yet, the reaction from the mainstream crowd is, "Oh well, it's time for a correction." The truth is, there's nothing natural about what's going on. Let's start with the numbers. Open interest on COMEX, the total number of active contracts, is half of what it used to be for gold. That tells you everything. If you had real speculative interest, that number would be exploding. But it's not. The speculative money isn't here. Hedge funds are barely nibbling. The only participants left in size are the market makers, the so-called jobbers, as we used to call them back in the day, and a handful of institutions sitting on large derivative positions. The shakeout we just saw wasn't a wave of retail panic. It was a targeted flush in the wholesale market, the domain of the banks and the big players. I've known these traders my whole career, the bullion dealers, the jobbers, the quiet professionals who can smell weakness in the tape like a shark smells blood in the water. They don't need to collude. They don't need a phone call or a secret meeting in a smoke-filled room. They can just feel when the market's overextended, when the buy side's exhausted, when it's time to hit it. And when one dealer feels that, the others sense it too. It's a herd instinct, a survival reflex. The moment one starts pressing the sell button, the rest pile in. And so we get these synchronized corrections that look awfully convenient, especially when you notice they happen just after large U.S. banks have quietly turned bullish on gold. Now, this is the irony of the moment. Jamie Dimon, the same man who once dismissed gold as irrelevant, now says he wouldn't be surprised if gold hit between $5,000 and $10,000. Morgan Stanley, the establishment itself, is telling its clients to allocate 20% of their portfolio to gold. 20%. You never heard that in 40 years of Wall Street research. The last time mainstream banks openly told their clients to buy gold, Nixon was still on television insisting the dollar was as good as gold. So when you hear Morgan Stanley say that, you have to wonder, what's changed? Why now? What's changed is the structure of the system itself. The banks know the fiat game is ending. They know debt is no longer a risk-free collateral. It's an exploding liability. So they're doing what every rational participant does when they sense the end of a cycle. They move to safety. And yet the market makers, the bullion banks, the derivatives desks, the same institutions who live and die by leverage, don't want to get caught short when the tide shifts. So what do? They engineer a correction to shake out the weak hands, square up their books, and reset at a higher base. That's what this is. It's not manipulation in the cartoonish sense of bankers smoking cigars and plotting conspiracies. It's structural, a reflexive system defending itself. The bullion banks have been on the wrong side of this trade for too long. They need to buy back metal, but they can't do it when everyone's euphoric. They need a scare, a sudden dip to create liquidity. So they lean on the market, trigger stops, drive prices down 5% to 7%, then quietly buy it back from panicked sellers. The result? The next leg higher begins from a cleaner slate. Look at the data. Gold down 5%, silver down 7%, platinum down 5.7%, palladium down 5.3%. After a parabolic rally, that's a rounding error. Noise in a long-term uptrend. But psychologically, it's devastating to traders who don't understand what they're holding. That's why I always tell people, don't trade this market. You'll go insane trying to outsmart professionals who've been doing this since the 1970s, who have access to leverage, information, and central bank flows you'll never see.
The central bank community, particularly in the global south, BRICS and so on and so forth, they can see what China is doing. With the SGE opening vaults in Hong Kong and also Saudi Arabia, and there are probably plans for other ones, or certainly facilities elsewhere, whereby gold can be exchanged for yuan. This is setting up a system which will allow the Chinese, if it is necessary, to protect the yuan's value by turning it into a gold substitute. But that would be at the international trade level. The idea that individuals in China would be allowed to have a gold exchange, if you like, for their yuan. I mean, I don't see that at all. The authorities in China, I think, are all about hanging on to what they've got. They don't really want to part with it. And I think it would be a mistake to sort of think that the Chinese authorities, whether we're talking about PBOC's reserves or whether we're talking about the hidden holdings, sort of spread around the various communist organizations, government organizations, I don't really see that they will be feeding this new vaulting system outside China. I think they're going to still hang on to their gold. But I think what they will do is they'll say, well, what you could do is you could acquire some gold, put it in that vault. You could exchange it for yuan when it comes to trade settling and all the rest of it, so that you foreign country, have the facility to trade in a gold-backed yuan. They will set the rate at some stage. I think that's inevitably what's going to happen. And it doesn't really require China to part with some of its gold. Maybe a small amount, but basically, I think the idea is to make the yuan, if you like, the dollar's replacement. And this one will be a lot more secure than the dollar. I think that's the important thing. And as the dollar declines, we're coming to, there's no doubt in my mind that we're coming to the end of the fiat currency system. The Chinese, I think, are perfectly aware of this, and they want to protect their currency. They want to protect, their position, and they don't want other currencies, for goodness sake. If the dollar goes down, what happens to the other currencies? They go with it. It's as simple as that. So they will want to trade in their own currency. Of that, I'm absolutely convinced. And they will want to protect the value of their currency. So we can see this is beginning to happen. Now, I think the central banks around the world can see it. I think governments are beginning to see it. I think some of the really big players, like ultra-high net worth individuals, the sort of really wealthy families around Asia, who liaise with politicians who have them round to dinner, and all the rest of it. I think this is the back chat that goes on with these meetings. They know about it. I think that some of the smarter hedge fund managers in the US probably know a little bit about it or suspect it. The rest of the investment world has not got a clue. But you'll find that the information filters down. It'll filter down gradually as, events unfold. And there will be if you like, a growing understanding actually about what actually is happening. And we're looking at the end of the fiat dollar. I think this is really what it's all about.
What's happening now in London and New York looks like déjà vu from every major inflection point in monetary history. You can almost feel the tension in the market makers' rooms. The quiet, coordinated dance of professionals who've learned how to survive on the edge of chaos. They're not evil masterminds. They're sharks in a tank that's suddenly running out of water. When liquidity evaporates, instinct takes over. The bullion banks, the traders, the desks that have been short metal for years are desperately trying to square up. And every time they push the price lower to shake out weak hands, they're actually revealing how fragile the system has become. The tell is in the open interest, or rather, the lack of it. COMEX gold contracts are less than half their long-term average, even as prices sit near historic highs. That means this rally isn't driven by speculation. It's driven by stress. The paper market isn't expanding, it's contracting. The leverage is being drained out of the system, not because traders are cautious, but because there's less trust. When open interest falls and price rises, it tells you one thing: the shorts are getting squeezed. They're being forced to buy back contracts, covering losses as physical demand drains the available float. We saw the same thing in the 1970s, the so-called Great Gold Run that ended with gold up 20-fold. Back then, it started quietly, with small pockets of panic inside the banking system. It wasn't the retail crowd that moved the market, it was the professionals losing control. And what's eerie is that we're watching the same pattern repeat, only on a global scale. Look at the behavior of central banks. The People's Bank of China is now the world's largest buyer of gold, and they're not doing it to decorate the Great Hall. They're buying because they've reached the end of their tolerance for dollar risk. You see, every time they buy gold, they're effectively selling U.S. treasuries. It's not a coincidence that gold imports into China surge when treasury yields spike. Beijing doesn't want to be left holding paper when the West debt experiment implodes. And yet what's fascinating is how misunderstood this move is in the West. Western analysts still think China's buying gold because of diversification. No, they're liquidating dollar exposure and repositioning their reserves into hard assets they control directly. They know that the fiat system's endgame is debt monetization. Governments printing to survive. Once you understand that, you realize gold isn't just an investment, it's a strategic defense weapon. Now let's look at silver, the wild cousin of gold. The one that moves faster, breaks harder, and tells the truth sooner. Silver is the canary in the monetary coal mine. When it starts to scream, you know the system is short of oxygen. We're seeing record backwardation, where spot prices trade higher than futures for over 2 weeks straight. That's not supposed to happen. It means people are willing to pay more for physical silver today than for a promise of silver next month. Why? Because they don't trust the promise. The largest silver refinery in India, one of the biggest in the world, has run out of stock for the first time in history. You can't overstate how extraordinary that is. India is not some small retail market. It's the second largest consumer of silver on Earth, after the United States. When India's refiners run dry, it's not a footnote, it's a warning flare. It tells you that physical silver is being hoarded, not traded. At the same time, managed money on COMEX, the hedge funds and algo traders, are short over $1 billion in silver, while the commercial banks, the insiders, are long. It's the exact opposite of what we normally see. The dumb money is betting on a crash. The smart money is quietly positioning for a squeeze. It's like watching a poker table where the amateurs are bluffing into professionals who hold 4 aces. And then you have the lease rates, the real-time pulse of metal stress. The cost of borrowing SLV shares, the largest silver ETF, is now around 19% annualized. In the LBMA, silver lease rates have jumped to nearly 40%. That's not a market functioning smoothly. That's a market gasping for supply. You don't pay those rates unless you have to deliver. It's the financial equivalent of pawn shops charging desperate people premium interest on their last piece of collateral. Now combine that with what's happening in gold. The same backwardation is creeping in there too. Central banks are withdrawing from the leasing market because they're realizing what every rational player eventually realizes. Once you lend your gold out, you may never see it again. For decades, central banks leased gold to the market to provide liquidity, to smooth volatility, as they put it. In reality, it was a way to suppress prices by creating artificial supply. But when that gold left their vaults, it didn't come back. It was rehypothecated, lent, pledged, and swapped until no one could tell who owned what. Now the system's running out of rope. The Bank of England's gold holdings have been quietly shrinking, with massive shipments sent to New York for arbitrage. Leased gold that's been converted into futures collateral. But when that gold leaves London, it's gone from official control. And here's the question no one dares ask. What happens if those counterparties can't return it? What if the gold is sitting in Shanghai, Dubai, or Moscow? What if it's already been melted down, recast, and absorbed into private hands? That's the scenario that keeps central bankers awake at night, because gold leasing is the plumbing that allows the entire paper pricing system, COMEX, LBMA, ETFS, to function. If that plumbing breaks, the market doesn't just wobble, it disintegrates. Prices would instantly decouple from paper quotes. You'd see a divergence between paper gold and physical gold so wide that the entire structure of financial trust would implode. And that's not theoretical. We've already had near misses. During the 2020 COVID panic, London's gold market nearly froze. Flights were grounded, refinery logistics collapsed, and physical arbitrage became impossible. For several days, futures prices in New York diverged from London, spot by as much as $70 per ounce. A sign that the two markets were about to disconnect. The only reason it didn't blow up completely was because central banks and a few major bullion houses stepped in to quietly patch the gap. But they can't keep doing that forever.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.